please start.
Good morning from Copenhagen. I'm Susanne Petersen, Director of the UNEP Copenhagen Climate Center. On March the 1st, the United Nations Environment Program, UNEP, announced that its long-standing collaborating center, the UNEP DTU Partnership, has been renamed the UNEP Copenhagen Climate Center. And in fact, we are now a part of the UN family, where the UNEP Copenhagen Climate Center will step up implementation of UNEP's climate change strategy and energy program. I would like to wish everyone a warm welcome to this Stockholm Plus 50 associated event that will dive into unpacking green recovery and discuss the opportunities seized but also missed in the EU and the Nordics during the pandemic. Stockholm Plus 50 is an important event for all of us working with climate and the environment. Indeed, today marks the 50-year anniversary since the 1992 conference, where 113 countries adopted the Stockholm Declaration and Action Plan for the Human Environment. Under the backdrop of this truly noteworthy celebration, we can't help but turn our focus to the future and into all that we still need to accomplish. Our side event today looks to the future and fits under one of the leadership dialogues of Stockholm Plus 50, namely on achieving a sustainable and inclusive recovery from the COVID-19 pandemic. In this panel dialogue with some very renowned experts from all over the world, we will explore the results of two reports that the UNEP Copenhagen Climate Center had the pleasure to contribute to, commissioned by the Nordic Council of Ministers. The reports explored the consequences of the COVID-19 pandemic and associated recovery packages, and their role in achieving the emissions reductions compatible with the 1.5-degree goal of the Paris Agreement. We will focus on examples from the Nordic countries and explore leapfrogging opportunities for non-state actors like the private sector and also developing countries. Stockholm Plus 50 marks a milestone in our collective journey towards a healthy and climate resilient planet, and it's my sincere hope that this panel discussion will offer you the opportunity to reflect on, celebrate, and to continue further build on these 50 years of environmental action. I would now like to hand over to Anne Olhoff, a former colleague of ours, now with Co2. Thank you very much.
Thank you very much, Susanne, and welcome to all of you to this associated event under Stockholm Plus 50, where we will be focusing, as Susanne just said, on the impact of COVID-19 and associated recovery packages on emissions pathways to 2030. And these studies have been made possible through the general support of the Climate and Air Group of the Nordic Council of Ministers. They were also used to give us the opportunity to provide more in-depth underlying assessments feeding into the annual United Nations Environment Program Emissions Gap Report. As Susanne said, my name is Anne Olhoff, and I have the pleasure of moderating this session. And I'll just quickly walk you through the agenda before handing over to our great panel. So we will start with presentations of the main findings of this project. And we have with us Glenn Peters from Cicero, we have Michelle Den Elsen from PBL, Netherlands Environmental Assessment Agency, and we have Takeshi Kuramochi from New Climate Institute. After the presentations of the main findings of the project, we'll move to two guest commentators. And with us, we have Marie Gustafsson from South Pole, who have also conducted an investigation, a project focusing more on the private sector aspects of COVID-19 and COVID-19 financing. And finally, on the guest commentators, we have with us Jean-Paul Adam from the United Nations Economic Commission for Africa, who will bring us some more global South perspectives of COVID-19 and also of COVID-19 recovery packages. Jean-Paul was also one of the lead authors of the Emissions Gap Report chapter looking into COVID-19 and fiscal recovery packages in last year's report. Last but not least, we will have Hans Jacob Eriksen from the Nordic Council of Ministers closing the event. Before that, though, we hope to have time also for some questions and answers. And to that end, we will be using Mentimeter. I'm told from our headquarters here, the control room, that you should be able to see a Menti code and where you can, throughout the session, type down your questions, and we will then return to as many of them as we can cover. And just in case you can't see it, the code that you need to enter when you go to menti.com is 95693874. So without further ado, I'll hand over to great colleagues, Glenn, Michelle, and Takeshi to present the main findings of the project. Thank you.
Okay, thank you. And great to be with everyone. I'm going to present the first part of the report, which relates to emission trends, what has happened, let's say, in the last decades, and in particular, the last couple of years. As everyone knows, there was rather dramatic changes during COVID, a big drop in emissions in 2020 and a strong rise in 2021, which I'll talk about more. But a part of the challenges with this is the methods that we usually use to estimate emissions are not as robust. There are a few more uncertainties. And so it's taken a little bit longer to compile some of the data this time around. And so what I'm going to present today is actually an update of what was in the Emissions Gap Report in November last year, and also in the report released today to include some additional information. So some hot off the press details. First of all, the big picture, this figure here shows global greenhouse gas emissions from 1970 up to, well, 2020, weighted with global warming potentials, for those of you that know about those details. We have had data on fossil CO2 emissions up to quite recently, and we know there was a big drop. Most estimates now are around about 5.5% drop in fossil CO2 emissions in 2020. And a strong rise expected in 2021. I'll talk about that more in a few minutes. But what is new that I'm going to talk about today is the change in methane, nitrous oxide, and fluorinated gases, the other greenhouse gases. How did they change in 2020? And we just have some estimates of that have come out. And perhaps not surprisingly, although may surprise a few people, methane, nitrous oxide emissions did not have as big a drop as CO2 emissions, and fluorinated gases grew. There is still some uncertainties around this because of the methods and the data that's available. But if you just think about this, if you look at methane emissions, about a third of the methane emissions come from fossil fuels. Now, there was a big drop in mobility during 2020 in the COVID lockdowns, but that drop does not necessarily correlate into an instantaneous, or maybe there's a lagged change in extraction activities for oil and gas. And so you may not expect methane emissions to go down as much as CO2 if you just look at the fossil components, but also a third, maybe 2/3 of methane emissions related to agriculture and waste, and likewise nitrous oxide emissions. And we don't expect as big a change in those components as they're not so affected, of course, by COVID lockdown. So smaller reductions in emissions with methane and nitrous oxide. The fluorinated gases, a little bit more uncertainty here, but things like the HFCs and so on, they have continued to grow on trend. So looking at the big picture, greenhouse gas emissions have grown around about 1% per year in the last decade. And in 2020, we expect a drop of around about 4%. By country, on the left, I have the absolute emissions here, and on the right, I have the per capita emissions. Chinese emissions have grown strongly in the last decades, and that continued through Corona. China bucked the trend, so to say. Most other countries have had a big drop in emissions in 2020. Many of these have rebounded in 2021. I won't spend too much time going on the details here, but it's all available in the reports. Sectoral emissions, This is a slightly different data set. We don't have sufficient information yet to give good detail going up to 2020. But you would expect the biggest drops, for example, in transport, or we see this for CO2 emissions, and the energy system, a little bit less in industry. The AFLU, so the agricultural sector in green there, surprisingly large sector when you consider methane, nitrous oxide, and so on, but we would not expect it to change too much in COVID, as I was just describing. So the next couple of slides, I'm just going to focus on fossil CO2 emissions. For fossil CO2 emissions, we have estimates available for 2021. The reason is we have much better data on what's happening in the energy system, electricity production, transportation, and so on. And so we can get quite an early estimate of fossil CO2 emissions. So you see the big dip in 2020 and a rather strong rise in 2021. Our latest estimate is that emissions in 2021, fossil CO2 emissions in 2021, are basically about the same as in 2019. So a full rebound in 2021. A few things to note there. Coal had a very big rebound. Maybe this essentially overcompensated for the changes through Corona. We'll see what happens in the next year or two. Oil, you'll see in the black here, is still a little bit lower than 2019 levels. That is because some parts of our mobility are still suppressed, such as international aviation, but we would expect that to recover a little bit in a few years. Gas and cement are basically growing on trend. And just slipping forward to 2022, of course, we're still during 2022 and there's a lot of uncertainty, but there are a few estimates you can use to give an idea of what emissions may do in 2022. Coal, I've just assumed here, is flat, of a lot of uncertainty around that. Oil, I think, is the most interesting one. We do have quite a few of projections of oil going out in the years ahead, and as I was saying, we expect there to be some sort of recovery in international aviation, for example, and mobility more generally, and so that oil is expected to creep up in the coming years. So the latest estimate I have here is 2.3% in 2022, and gas and cement I've assumed to grow on trend. So taking all those in together, that would point to emissions growing about 1% in 2022, continuing on that upward trend, although there's a lot of uncertainty related to coal in particular. There's big changes going on in China, related also to Corona. There's, of course, the war in Ukraine, and lots of uncertainty associated with that, and the global economy is slightly depressed. So a lot of uncertainty with 2022, but all indicators at the moment point to an increase in emissions in 2022. And now I'll hand over to Michelle, who will talk a little bit more further forward out to 2030.
Thank you, Glenn. My name is Michel Nelson from the PBL Netherlands Environmental Assessment Agency. So I'm going to present the chapter sector level assessment of the impact of COVID on the future emissions up to 2030. The next slide, please. Yeah, so this chapter basically explores the impact of the pandemic on the greenhouse gas emissions to 2030 at a global level and also at a sectoral level, and for 4 major emitting countries. The analysis that we are going to present is based on 2 scenarios. So a current policy scenario in a pre-COVID situation, so pre-COVID current policies, and then a scenario including the impact of COVID, so the post-COVID current policy scenario. And the analysis itself makes use of the image assessment model. This is one of the integrated assessment models, including an energy model at the level of 26 world regions, including the EU as a group, China, India, USA. And the energy model also includes many energy sectors. So this is already next slide. So the post-COVID scenario is basically includes the policies implemented before the cutoff date of November 2020. It does not include the impact of the pandemic. And the pre-COVID does account the drop in 2020 and also the macroeconomic impact. So what we see here is basically the results that we are using from basically on the GDP projections. So the GDP projections is based on the official projections, including the OECD, the European Commission, the Finance, and the World Bank. And we are making also adjustments in the economic activity levels from the consumer spending and so on. And based on that, what we see is that the GDP growth is the drop, first of all, the 5% drop, and then the lower projections. And in terms of the CO2 emissions, we see a small drop of around minus 0.5% in 2020, and then the growth continues. So what we basically see that the impact of the GDP and the economic indicators is not enough to represent the drop that we have seen in the CO2 emissions from the activity levels. And then for you, next slide, please. That we do in the final calculations, and there actually we take into account the GDP impact and the drop in the economic activity levels, and also the reduction in the demands and the activity levels from the impact of COVID. And we are focusing on 4 sectors. So basically the aviation, the surface transport, the industry, and the residential and the public buildings. So we take into account all the data available, the activity data available in 2020. And then we are assuming that for the projections, it refers backwards towards the pre-COVID growth rates. So that's also being described in full detail in the publication below. Next slide, please. Yes, and then the final results is basically this table. It basically shows the impact in the global energy and industry-related CO2 emissions for the post-COVID scenario compared to the pre-COVID current policy scenario on a sectoral level and at the level of different countries. So it basically shows a 7% reduction in 2020 relative to the pre-COVID, which is about 6% compared to 2019 levels. And in 2030, we see that the impact of COVID is about a reduction of 9% compared to the pre-COVID projections. It's the main contribution, the power sector. It also shows that the majority of the reductions indeed come from the energy supply sector, the power sector, and followed by the industry sector and then the transport sector. And if you look at the results for countries, on the global level, we see a 9% reduction in 2030, followed by a 6% reduction for China in 2030, a 5% for the EU and the USA, and even higher reductions for India, about 10%. Next slide. Yeah, well, that's basically our main message that are being described here. So basically it leads to a reduction of around 9% by 2030. And the majority of the reduction comes from the power sector, followed by the industry sector. And yeah, I will keep it here. Hand over to Takeshi.
Thank you, Michelle. So now the emissions projections that Michelle just presented, this does not explicitly account for the potential impact of the rescue and recovery spending that national governments have made during the COVID period. Next, please. So we wanted to know what has happened with all these COVID recovery spending in the last after 1.5 years since the COVID pandemic started. And in the earlier phase, there was a big expectations on the green recovery and their impact on future emissions. So we were very interested in exploring the actual impact on future emissions. So this policy brief we just published is based on the UNEP emissions gap report, which is led by Brian O'Callaghan and John Paul Adam, who's here with us today, and our colleague Frederick Hans as a contributing author. And we also have published our own analysis of COVID recovery spending, which analyze across multiple recovery tracker databases. Next, please. So in our assessment, we looked at 2 things. So one is the level of greenness. You can see both low carbon and high carbon, and also the third category in between, that's the supporting the status quo, meaning that the spending, it's not always clear whether it will reduce or increase emissions, but at least supporting what it is today, and as a result, locking in the emissions over the next decades. And for the emissions impact type, we looked at direct impact and indirect impact. And for indirect impact, we further categorize, separated into 2. One is supporting more enabling environment, and the other one is more that would support catalytic changes over a very long long term. So these include R&D spending, for example. Next slide, please. So now we look into the results on the 10 major emitters plus the selected EU member states. So here's the results on the recovery spending by the level of greenness. So you can see that more than 70% of the spending does not directly influence the emissions. So we focus on this remaining 25% or so of the recovery spending. And one would expect that much of this spending, which would affect future greenhouse gas emissions, would be predominantly green if they follow all the pledges that they have made. But that's not the case. Only less than a fourth of that spending is actually identified to be low carbon. And a larger chunk of spending actually supported the status quo, meaning that locking in the current emissions. The good news is that there are very few projects, very limited spending that would explicitly focused on high carbon projects, such as new coal power plants. It is also worth noting that sizable amount of funding, the spending, we could not identify how exactly they would affect the future emissions because of the lack of information, or these spending that are committed do not have enough details at this moment. Next, please. Now we look into the country level results. So in the middle, you see the EU 16 member states. So the total amount of spending as a share of GDP is not the highest among the countries. But when you look at the content, EU has a very high share of low carbon spending, which is good news. At the same time, there is a sizable amount of spending that is spent on supporting the status quo. Next, please. Then we look into the recovery spending by the emission impact type. So here we focus on the spending that were labeled as low carbon and high carbon. For both spending, we can see that the majority of the spending was supporting more will lead to indirect emission impact. And only about 40% or so would have a direct impact, meaning that these impact would sort of emerge in a shorter term. And next, please. And that was also the case for the low carbon spending of the EU member states. Next, please. Now we look into the Nordic countries. Here's the results from the Oxford Global Recovery Observatory, the COVID spending tracker database. Here you can see the share of green recovery spending as a percentage of total recovery spending. And you can see that the Nordic countries overall performed better than most of the European Union member states, and also most other developed countries overall. So this is a good news. Next slide, please. So when you look at the details of the spendings for Nordic countries, there are the green recovery opportunities that are seized, but there are also some opportunities that are missed. On the left-hand side, we show some examples of these green recovery opportunities seized. And I think all of these are very relevant and effective in the current energy crisis we're facing. On the other hand, the missed opportunities, there were some emergency support on the Scandinavian airlines, or also preferential tax measures on oil and gas production. Of course, these were made under specific circumstances, so we're not judgmental on those circumstances, but nonetheless, these projects spending would support the status quo, locking in current emissions, or lead to even higher increased emissions from today. And the South Pole team, Marie's team, has done a deeper dive into these spending. So I'm very much look forward to the insights from her presentation today. Next, please. So the summary of the findings. On the global level, there was all a big expectations on the green recovery during against COVID-19 pandemic, but what we observe so far is that they have only partially reflected government's pledges. So that was rather unfortunate. And also, when you our in-depth assessments on the spending shows that the spending made to date will only likely have a limited impact on future emissions. And if they are to be sort of become visible, then that will be only in the longer term, and not, we don't expect any visible impact before 2030. On the Nordic countries, the literature suggests that they have performed better than most other developed nations. However, there were a few measures that were considered to lock in emissions or increase emissions. Next. And here are a few policy recommendations for the EU and the Nordic countries, which are also valid applicable to most other developed nations. So first one is to enhance the preparedness and develop capabilities to be able to better design rescue and recovery measures in times of emergency, in line with the low carbon transition. So countries have scrambled to rescue their economies, but often there was guidelines lacking on how to ensure that these spendings are low carbon or in line with their decarbonization objectives. So that kind of either legal framework or some kind of guidelines would be recommended to be established. And the second, third recommendations, these are more in general for fiscal spending. So first one is to further streamline low carbon spending into annual fiscal budget cycles. So the green spending or low carbon spending is not just about the spending in times of emergency, but it has to be a regular thing. So the whole further streamlining of low carbon spending will be very important. And lastly, in times of emergency, like the COVID pandemic, the countries have mostly focused on saving their own economy, but the developing countries have suffered more than developed countries, and increased and targeted financial support for these countries would also be very, very important. With that, I will close my presentation. Thank you.
Thank you very much to the three of you for excellent presentations, and I will pass the word directly on to Marie Gustafsson from South Pole. Marie, the floor is yours.
Thank you very much, and I am trying to share my screen and hope that will work out fine. Good, perfect. So thanks a lot for the presentation. That was very, very interesting to have that also as in connection to the study that we have done. So giving a short background, my name is Marie Gustafsson. I'm a principal consultant at South Pole. This study on financial instruments to support green economic recovery post-COVID-19 has been undertaken by us, as well as together with our partner Gaia, who is based out of Helsinki. And I mention this because it's relevant for the report. So we are both climate solution providers and work with a lot of corporations worldwide or in the Nordic, respectively. We have just published the executive summary, but the full report will be released in August. A bit of background on the project was that the objective was to identify and analyze the different post-COVID recovery financial instruments used. But a key part of the work was really to engage with the civil society and private sector. So a lot of the initial phase of the study was desk research, but then this was completed together with interviews with over 20 stakeholders, focus groups, and now we're going into a dissemination phase of knowledge sharing, and I'm excited to share some of our key findings with you here today. So directly jumping into the findings, a little bit repeating certain things that Takashi said, but I think it's interesting that we have reached certain similar conclusions. So overall, there were robust COVID-19 recovery plans in all the Nordic countries, either as part of the Next Generation EU or proprietary recovery programs. As Takeshi mentioned, in EU, there was a high rate of green spending as part of the recovery programs, and also in the Nordics, it was particularly high. So seen in an international comparison, Nordic is among the leadings there. However, there is a certain difference also between the countries. It depends a bit on what metric you're looking. If you look at the percentage compared to total spending, or in terms of recovery spending. There was a breadth of financial instruments used in all countries for the recovery spending, but the key ones used for all the Nordic countries were tax reform, credit creation, and liquidity support. Looking slightly bit further into them, the most commonly used, then starting from the right, was the liquidity support, used for short-term recovery and to support really businesses of all sizes. So from SMEs to really large corporations. Further, also tax reforms were used, so tax rebates or postponed requirements to pay the taxes to really reduce the financial stress on businesses. And then further credit creation, so dedicated credit lines or preferential conditions or loan guarantees were also used as an instrument for during the COVID crisis. With maybe an obvious fact for many, but still worth pointing out that most of these instruments depended really on public funding. So the financial burden has really fallen on the governments, and that's one of the points I will come back to. So then drilling a bit down into rather the interview results, like having this framing. What we found is that actually most financial institutions and private companies saw no significant change in their sustainability mandates as a result of a pandemic. And as mentioned, like Nordic actors are really leading in the green transition and taking on best practice. However, there is seen a certain shift where the industry ambition is actually moving ahead of the states. And here, coming in on like the day-to-day work that Gaia and South Pole does, that we are in touch with a lot of corporates, and we see there the pressure, and that was then also part of the interviews, that we see a pressure from investor, consumers, and also the conviction of management in corporates to act, to take climate action. This pressure is constantly increasing, and has been pushing the private sector in spite of COVID. However, this where politicians and governments are uniquely placed is really to affect the economic case of green transition. So the political landscape is the ones that must make it unprofitable for businesses to do the wrong choices, and in short, to emit greenhouse gases. And it must become profitable. There's like an urge that it must become profitable to do green invention through subsidies, incentives, risk share mechanisms, for instance. That this must work properly to push society in the right direction. And this is also actually mirrored in the latest IPCC report. Finally, a very common theme, but still to be mentioned, the green technological innovation is really needed for the society net zero transition. And then we also looked at the barriers for the existing post-recovery findings. So now, when we are passing from, say, the more urgent actions to the long-term transition, what are the key barriers there? So the barriers presented were the limited financial support for new players with technologies, green technologies, or say changing business models to more sustainable business models, due to that there's high risk and low return profiles. So here there's really an urge for more investment risk reduction. So, for instance, loan guarantees or just risk sharing mechanisms in general, because it can be hard for individual corporates to push this. Further, that the hard to decarbonize sectors, so like the supply chains, are the ones that remain a challenge. It is always easier to manage what is within your own operations, or maybe even within your own geographical borders. But then the supply chain, especially what is abroad, it's much harder to manage. Further, another barrier presented was the fragmentation of the recovery finance that was delivered. So there was a mentioning of like misdirected grants, and that sometimes there was, let's say, a mismatch, so that there are fundings available, but they are not directed to the areas where it would be needed. There was like a just too fragmentized, and here there is definitely room for cross-sectoral collaboration and more aggregation of funds and matchmaking. Finally, and which I think is very links to the previous report presented, like really looking into the numbers is also key, and that there is guidance on how measurements should be done, like having clear guidance on how climate action should be done and how it should be measured. So, for instance, the EU taxonomy, who is really has the ambition and will definitely accelerate the green transition, it's still perceived as quite daunting for many corporates. And here, providing more helpful guidance is really asked for. As well as then also transparency and standardization on, for instance, data and measuring, both for corporates when they measure their own emissions, but also for measuring the impacts of the instruments used. So ensuring that the money has gone and made the impact that was intended. And with here, I will end my presentation for now, and looking forward to Q&A.
Thank you very much, Marie. And without further ado, I'll hand over to Jean-Paul Adam to bring a more global and global South perspective on the COVID-19 and the recovery packages. Jean-Paul, the floor is yours.
Thank you so much, Anne, and thank you to all colleagues. It really is a pleasure to be able to join you from Addis Ababa. I think one of the main elements that we firstly need to keep into account in terms of the global context is that the pandemic has impacted African countries, especially in different ways from the rest of the world. Firstly, because of the structure of African economies in the first instance. So African countries have done relatively well, particularly after the turn of the millennium, on essentially driving trade-driven growth, which has been based on large amounts of exports, in particular of raw materials, unfortunately with limited value addition. So this growth between 2000 and 2010 and just after has actually driven quite a lot of people out of poverty. And in Africa, prior to the pandemic, a majority of citizens in Africa actually live within what is formally defined as a middle-income country. But the problem is that the resilience of those populations that have been moved from extreme poverty into perhaps a middle-income status is not as strong as we would like it to be. And this is particularly because of the structure of the economies, which are very much driven by external demand. So the COVID-19 pandemic really increased the pressures, particularly on vulnerable populations. And we saw an additional 55 million people across the continent driven into poverty. The scale of resources that could be mobilized to respond to the pandemic were also dramatically different. We saw that across low-income countries, the majority of which are African, the average spend per capita was only $57 per capita, while in emerging market and developing economies, in average, it was $578 per capita. But in advanced economies, it was dramatically higher at over $11,000 per capita. What that means is that the response to the pandemic could not be one of large amounts of fiscal stimulus, and the majority of financing that was available in Africa and the developing world went mainly towards direct transfers to populations. And there has hardly been any investment in the type of infrastructural changes that are necessary across the continent. This is particularly unfortunate because the studies that the United Nations Economic Commission for Africa have done have shown an extremely strong return on investment by investing in green sectors relative to fossil fuel-based traditional sectors. So in a number, we've done 4 country assessments so far, and we saw, for example, in countries such as Egypt, from investment in renewable energy, a return on investment of 400%. In Kenya, almost 300% return on investment on investments in renewable energy. In terms of investments in low emissions transport, in Egypt, we saw a return on investment of above 400%, in South Africa of almost 300%. While if we look at utility scale renewables, we saw in the Democratic Republic of Congo of a return on investment of almost 300%. So the infrastructure element, which is linked to energy and low emissions transport, are particularly striking. But what we found was very interesting as well is that there is also, in African countries in particular, a very strong return on investment in sectors that are more linked to adaptation, including particularly looking at climate smart agriculture and sustainable water usage, where in the Democratic Republic of Congo, investment in these sectors brought a return on investment of almost 500%, and in Egypt, again, of almost 500%. Natural capital investments, where we look at rehabilitation of the natural environment, and particularly the link that this has with, for example, access to water. We saw very strong returns of investment in both South Africa and the Democratic Republic of Congo, where they were between 150% and 200% return on investment. So the big challenge for African countries has been actually, in the first instance, the availability of liquidity to invest in the type of infrastructural changes that are needed. And this is in contrast to the more global north, where the availability of resources has been there. There has been a focus on immediate response, dealing with the vulnerable populations. There has been investment as well in the changing of the narrative in terms of investing in infrastructure, which moves towards more low carbon development, but certainly not enough. And I think we've seen in the presentations, there is a large element of a missed opportunity. But the core message that we have seen from our work is that the opportunity is perhaps even more striking in the developing world and in Africa. The way to achieve it is by particularly de-risking the investment in the developing world and in Africa, because a large amount of the investment, particularly coming from the private sector, is not going into Africa. If we look at green bonds, for example, which have been one of the major sources of investment from the private sector into low carbon infrastructure, less than 1% is currently directed towards Africa. And one of the main areas that we need to address is how we can use blended finance to de-risk investment, particularly in the developing world and particularly in Africa, which will bring actually huge returns of investment, which will benefit both populations within emerging economies in Africa, and will also generate, I think, a new era of growth and development for the global north. So I think there's a synergy to be achieved, but it is about channeling the finance to the areas that need it most. And unfortunately, that has not yet happened. Those are my introductory remarks, and I look forward to further engaging on these subjects through question and answers. Thank you.
Thank you very much, Jean-Paul, and thank you to all our speakers. We are now at the point in time where we will open the floor for a Q&A session. And I would like to start off the Q&A with a really tough question that basically goes to all of you. And most of you have related some parts of your presentation to the current situation with the war in Ukraine, which has caused food, energy, and commodity prices to skyrocket. And also, we have new forecasts of global economic growth being negatively affected by the crisis. And for instance, you mentioned, Jean-Paul, that in Africa, a lot is driven by external demands, and we've seen that food imports and exports and grain exports are heavily influenced. We heard Glenn mentioning that the current conflict adds to the considerable uncertainty surrounding emissions in looking ahead. And it is also compounded by the fact that China is still having major corona lockdowns, and that we still have global supply chains affected by the COVID crisis. So what I would like to do is just to open the floor to all of you to get your perspectives. First of all, how do you see the Ukraine crisis affecting both global emissions and also a green transition? Because both the COVID recovery spending and the Ukraine crisis has been mentioned as an opportunity to accelerate a green transition, and we missed out on that opportunity in relation to COVID recovery spending. What are the differences? Any signs or any ways of not making the same mistake here? So let me just open the floor and see who of you would like to speak to this point. And of course, also if we can learn something from the COVID recovery spending and the do's and don'ts, including the policy recommendations that Takeshi mentioned in his presentation.
I can maybe start off, and then happy to hand over the word further. So one initial comment is that to a large extent, like the COVID pandemic impacted a lot of the demand, whereas now many of the the Ukraine crisis is causing us a lot on the supply. So there are some differences there. I think something that both myself and Takeshi touch upon is that from a financial point of view, like now there has been some immediate action to reduce the effects. But after taking these immediate actions that you need to take to really ensure that you implement policies and other incentives that also work in the long-term run. And I think that we are seeing some actions taken that will have a positive long-term effect, but there are also still some short-term effects that can be worked a bit more on.
Thank you. Anyone who'd like to?
Yeah, maybe I can chip in as well. I guess starting from the easy part and getting to the complex part, I guess the easy part is you would expect the global economy to be somewhat depressed, not necessarily going into negative growth, but let's say growth will be a little bit lower, all else equal. You would expect emissions to be a little bit lower, and that will have consequences in the years ahead, essentially along the lines of Michelle's presentation. But then when you get to more specifics, and if you look at policies that have happened, petrol prices are high, gas prices are high, and the reaction is, well, governments will reduce the taxes on those or put in policies to relieve the price pressure, also of electricity prices. And so the effect is people probably continue on as they continued on, not noticing that the prices are high. So that probably won't lead to any structural changes. So I would expect, let's say it'll be a bit of a dip or lower than you would expect in 2022. And then depending on how long things reverberate around the world, then things will just come back to normal. I don't necessarily see much concrete action, certainly widespread, that would, let's say, accelerate a shift away. The potential is there, just like with Corona, the potential is there, but no one really wants to grasp that potential, I don't think.
Thank you, Glenn. Anybody else who would like to come in on this question?
So if I can come in a little bit from the African perspective. Africa has been hit the most by these crises in terms of the costs of the increased prices because of the lack of capacity to adapt. I think what has been striking from the COVID-19 pandemic reaction the global north, and also in the reaction to the crisis in Ukraine, is the almost infinite supply of money, which is very different from the situation in Africa, where the fiscal deficits have been dramatically emphasized by the succession of crises. The average, over the COVID-19 pandemic, the average fiscal deficit in Africa was -8%. And the ability to raise additional finance is very limited because tax to GDP ratios are around 16% of GDP on average, and in some countries are below 10%. So there's very low resource mobilization in these countries. And because you don't necessarily have a large economic base, when you have a depressed global economy, this also further exacerbates the ability to raise income. So you need to have a growth scenario which is not happening because of the reliance on these raw material exports. So and then you have the potential response, which should be towards investing particularly in energy sources that provide reliable prices in the longer term. In Africa, I think there's, and of course we overgeneralize, but there would be, I would say, a consensus. We all know that solar energy provides the cheapest form of energy today, and the majority of African countries would jump at the chance to invest in this, and a number of countries are doing that. But the problem that is not recognized is that you achieve those low prices often when you've already got strong base generation. There are 24 countries in Africa, almost half, where less than 50% of the population have access to electricity. So the investment in base generation that needs to happen is dramatic. This can be done in many cases using renewables, but it involves a hugely large-scale investment, because if you're going to create base generation with renewables, you need to invest even more than if you're just adding on, as you have tended to do in the global north. And this is why a number of African countries have tended to revert as well to sort of saying, well, we need to develop fossil fuels as well, because otherwise we can't bring in the renewables. And I think there's been a lack of understanding of this. And this is one of the things which is actually a barrier for investment in the developing world, because in all scenarios using existing technology, in regions such as Africa, you will tend to increase the fossil fuel consumption per capita before you decrease. The trend means that you could, with the right mix, lead to that decrease, but the investment needs to happen massively upfront. And even in the response to the Ukraine crisis, we've seen some beginnings of approaches to Africa in terms of how they could potentially generate a lot of the energy that would be needed, but not enough investment is actually flowing. And the understanding of where that investment will go, I think, is still not properly understood. And but to flip the coin towards more of the opportunity is that if we are to go down new energy sources like green hydrogen, and also by providing massive investment into the right sectors in renewables in Africa, we can actually stimulate growth, I think, to a level which is unprecedented, both for Africa and for particularly the countries that would channel that investment into Africa. Thank you.
Thank you very much. Let's have one more general question before we move to the closing of this session. So you all mentioned examples, so good examples of where the COVID recovery financing has been used to accelerate a green transition, and also, of course, a number of bad examples. And we saw that the Nordics have performed above average, way above average. So maybe you want to expand both on why have some countries performed better than others, and also can you maybe go a little bit more into some of the barriers that we need to remove going forward from your various perspectives? And I don't know who would like to start us off. Marie, was that a hand?
It was not, but I can start if you like. So I can just mention, so our report didn't focus on the reason why different countries invested certain amounts or not in the recovery, so I will not go into that. But I think on the solutions, or like on the challenges which are there, is that there is, as we mentioned, the key part of the funding is still coming from the public sector, and we need to focus on de-risking mechanisms in order to really also mobilize the private capital to take care in any investment, but also in recovery, that is now the other topic, and in low carbon transition. And there are examples of good risk sharing programs. There are some in the Nordics, there are some globally, there are some climate funds, for instance, doing that. But I think that's definitely one of the key topics to dig further into, because we need to mobilize not only public capital in order to transition the society. And there is a will from the private sector to do it, but the risks are still too high in many cases.
Thank you, Marie. Takeshi, I don't know if you want to come in. We saw quite a lot, I would almost say an increasing disparity between the countries that are already quite well advanced on a low carbon transition path, who were more easily able to use the recovery funding as a means to accelerate a green transition. Do you have anything to?
Yes, thank you. Well, that's a very difficult question to answer, but there is an emerging literature that looked into the motivation of countries on this fiscal spending during the COVID times. And these literature suggests that much of the spending is really kind of determined by the pre-COVID political agenda, so the political priorities. So countries like the Nordic countries always had the environment and the climate change high on their political agenda. So that might be one of the reasons, main reasons, that they have a higher share of green spending also during the COVID times. And you also see the South Korea, for example, they also have this agenda, green economy agenda, high on their political under politics. So that might be one factor.
Takeshi. Michelle, do you want to add something? I'm just mindful you haven't had the opportunity to speak yet. Don't have to. It's fine to say no. Anybody else who would like to come in before we turn to the closing?
Perhaps quickly, I think the opportunity for example, the United Nations Environment Programme has worked on a green budgeting framework, which would allow easier measurement of the impact in terms of emissions of certain fiscal decisions. And this is something that we're looking at to roll out for COP27. But I think for it to really be successful, we need to look at it globally, not only in developing countries, because it's the flow of finance globally which will have that impact. And just to echo also what Marie had said, the private sector has to be brought in very dramatically. And that includes in the developing world of deepening the market and having some of the same types of mechanisms that you would have in the global north to be deployed in the global south. So blending is a big part of it, but there's also the opportunity, for example, of developing a repurchasing market for green bonds, where bonds could be issued more often, creating a flow of finance into those slightly more developed middle-income markets, and creating more opportunities for investment that is linked to this green infrastructure.
Thank you. And with that, I would like to thank you all very much for your excellent presentations and interventions. And we will now turn over to Hans Jakob for the closing remarks. The floor is yours, Hans Jakob.
Thank you very much, and thank you for all your very, very interesting interventions and presentations. I'll do my closing remarks with a couple of ideas, because listening to all your interesting presentations, I've actually come up with some few ideas where the Nordics perhaps should do more. On the one hand, all we have heard today is related to the Paris Agreement and 2.1c. The paragraph 2.1c says that all financial flows should be aligned with the Paris Agreement temperature goal. And somehow we can see that governments have not grasped that opportunity in a fully manner yet. To some extent, I would also say that they perhaps are a little bit excused. We also heard today that past the COVID crisis, countries have scrabbled to save their economies, also giving them, you could say, limited time to really rethink or more strategically think, how do we actually do this? a few other takeaways. I think there's an opportunity here to do more work related to all the presentations we have seen here today. And then with the OECD, perhaps, there's a coalition of finance ministers for climate action who is working intensively on actually being better on integrated, you can say, fiscal policies with climate change policies. And I'm happy to say also from the Nordic Council of Ministers, we're actually supporting you can say, interaction between the Nordic countries' ministers of finance on fine-tuning these modelings. And I'm sure this could have a bigger bearing on not just the Nordic countries, but within OECD and to the wider world, of course, in the longer term. And then I think there are some very interesting findings also, or lessons learned from the situation or the description you gave, Jean-Paul, from the African perspectives. I'm surprised, or surprised by the high rates of return that you mentioned on almost across the board on all renewable energy projects. And I think perhaps there is some lessons to be convened from the Nordic countries also on how have we set up exactly de-risking mechanisms or funding structures that can leverage both public and private financing to developing countries. I think we, from the Nordic Council of Ministers, could do more on that note, perhaps together with South Pole. Okay, I don't have any other closing remarks. I'd like to thank you all for very, very interesting perspectives and lessons learned. Thank you. Okay, we'll close the meeting for now. Thank you everyone for taking part, and see you some other time around.
Thank you.
Thank you. It's been a pleasure.
Thank you
Thank
very
you so
much,
much, everybody.
Thank
Thank
you.
you.